Thank you very much, everyone. Welcome back to Digital Davos, live stream from Davos, Switzerland. I have here with me David Doss from CKC.Fund, Catalina Galles from
C-Fund.
C-Fund.
So we have CKC and C-Fund.
I apologize.
It's
interrelated,
a beautiful connection.
And I'm Carl Sidig from Digital Davos. Thank you very much. And David, I will give here the moderation to you.
Okay,
please.
We can exchange the moderation if we like. So it's a tokenized moderation. Yes.
It's decentralized moderation.
Okay, perfect. So yes, the topic for our panel right now was Innovate, Invest, and Inspire: Leading Trends for Tomorrow's Private Markets. So briefly on my background, and I think we had all wanted a chance to introduce ourselves briefly. I am the head of CKC.Fund, which is a emerging fund manager in the digital asset space. We focus on fundamental analysis-driven approaches to mitigating risk and increasing returns in the digital asset space. We are a proud partner of Chain DLX. Carl, perhaps you can introduce yourself as well.
Thank you very much. I'm Carl Sidig. We are the host from Digital Davos, and we are a segregated portfolio company in Cayman Island, which hosts different venture funds and offshore entities, and provides also marketing services in Davos, Switzerland.
Wonderful. And our guest today, Katalin, if you could please introduce yourself as well.
Thanks, David, and thanks, Carl, for the invitation. My name is Katalin Gayesh. I'm the managing director for C-Funds. C-Funds is a boutique fund placement agency headquartered in Amsterdam, but we also have a Singapore office. What we do is capital raising in private markets, focusing very strongly on top brands, venture capital firms, and many of them also blockchain related. But also we serve other asset classes such as credit, real estate, and hedge funds. And we have 13 deal brokers across the globe, and we manage 550 investor relations.
Wonderful. Well, you mentioned credit, venture, private equity, hedge funds. This is on our topic of the day. Perhaps you could start us off with a few observations of where you have seen the private investment marketplace going over the last year in relation to some of those subsectors.
Sure. So as you know, 2023 was very bitter in private equity, private markets. It has to do with geopolitical risks and the uncertainty, and the high interest rate made the exit markets very bad. And that has led that VCs disappointed the investors and they backed off a bit. This asset class we love very much, but it's very high risk and high volatility, as you know. And especially smaller managers suffered a lot below 500 million target size. Many of them weren't able to finish the fundraising targets, whereas other asset classes, credit remained quite stable. There is a lot of appetite for liquid funds, so hedge funds got lots of attention. Secondaries as well, because it's a very good liquidity creator in many funds. So we see the expectations are now that the second half year 2024, the markets will be back in private equity as they were before 2022. But we're really looking forward to see that.
I think it will be good to have a increased positive momentum in some of these markets. We've been seeing this, for example, in the blockchain and crypto, the digital asset space, of an increasing momentum towards kind of a return to that more, let's say, sustainable growth of the markets in years prior to COVID. And I agree that the latter half of 2024, I mean, coming from the perspective of the digital asset space in particular, a lot of the experts in the space are predicting major waves in the latter part of this year. Carl,
related to this, when we are looking from the Chain DLX side of view, we research is more cautious, and we see a decline in 2024 for a lot of funds. We see that it will be necessary to be diversified. We see an incline in the crypto space. We see, but we see in the VC space really risky investments right now because of the high interest rate and the geopolitical moment. So we expect that it will take around 6 to 7 months to have a clear picture for investments. And for this, we are right now more concentrating on asset classes like crypto diversification and asset classes which can, with a high interest rate, which is like right now from the central bank given. And when you see also that AT&T, the bonds are right now by 17%, so every fund has to at least beat this threshold. And this is only possible with really good cured VC funds in the long run, or with crypto. But with normal traditional hedge funds, which are in other asset classes, we like S&P 500, and only control on the alpha risk, we see problematic. So this was.
There are a lot of topics
research
there. So relatedly, I think there's some research recently from, for example, PwC issued a report on a couple of these related topics. It seems that, for example, hedge funds as well as debt seem to be increasingly popular as basically high liquidity mechanisms. Katalin, I think you had mentioned also debt in particular. Perhaps you could remark on that in this climate.
Of course, you see SMEs suffer a lot, innovative scale-ups suffer a lot. There is a very big funding gap if you reach a certain amount of growth, especially Series A plus tickets. So there you have the venture debt, and there's an incredible huge market coming in there in private debt, especially if it's collateralized. We've never seen so many funds, GPs that are being created successfully, especially if you mega fund. Mega fund is 1 billion plus, because then in fundraising is almost mechanical. If you're a big brand, the certainty, trust is there, and there is many re-ups. Investors, LPs coming back because they know the team, the due diligence is done, and instead of 800 million, now it's 1.5 billion. It's an easy re-up. So we saw that these guys remain very established, and this mega funds unfortunately took also lots of money away from the market from the smaller talented players. And another advantages of credit, it's very conservative and of course lower yield, so it's less experimental than VC. So lots of families that were, for example, focusing only on real estate, and they have very conservative view on the market, they would go after real estate or credit funds. So, but I hope we love very much venture capital also in my firm. We have the same DNA, so hope really that it will recover soon.
Yeah, so I mean, in that regard, in those trends, you're talking about the large funds versus the small funds, and this is something interesting. Would be curious to hear your thoughts on in relation to VC as well, because coming from a more of the hedge fund perspective, we have been seeing in a climate like this is especially with some of the more emerging assets, that it is more of the emerging funds as well that tend to take on those types of initiatives, where you can see a very odd juxtaposition in some of the larger funds in the crypto space, for example, where they pay lip service to blockchain and digital assets, but do not do much with it in the current climate, whereas it really has started to fall onto the emerging fund managers. So given that you have interest in kind of more of this, let's say VC, and also that you have interest in ESG initiatives, social impact initiatives, how do you see the interplay between those interests?
Oh, okay. I think what is very exciting in the private market is that pension funds is of course huge amount of dry powder, and very exciting factor in private equity. For the first time, they also allocate money for smaller managers, but only if it's related to ESG. And climate tech is the most popular. I always tell example for fundraising the last couple of 4-5 years, there is an evolution of fundraising success. And of course, it started with deep tech VCs, they were very popular. Then you had, of course, AI is still very popular. And what is now very popular is sustainability, climate tech. And even if the brand is not so established and the team is not so well achieved, if you have this thing, it's very supported to get investment tickets, especially if you're a spin-off of a bigger organization. Like we work also with investment banks that launch now a smaller climate tech funds, and therefore for them is the fundraising it's much easier than emerging managers without GP experience. Yeah.
Do you have the experience, and this is just interesting because there's a vast body of research which shows constantly that new funds outperform our old funds.
Yeah.
New fund managers are always like this, and this is also like when you see a hedge fund going over 30 years, you see they don't outperform normally even the S&P 500, but the new funds in the beginning always outperform it. So when you see it like this, and ESG is becoming right now interesting to you, do you see an outperformance from all the funds, or do you see the funds which are most considered in ESG outperforming even the other funds? So when you see it in this perspective, when you adjust your data for new funds versus old funds, because the ESG funds are more modern new funds.
I think that GPs are performing good based on also merits, and merits are of course the legacy and the team. And of course climate tech is good, but not necessarily everybody is capable to run such a fund. And the ESG funds have also from pure family office perspective and LPs also very big administrative burden, you know, if you Article 8 and 9. And I would say it accelerates the rate of fundraising possibility, but it not necessarily accelerates your portfolio output, only if you have a stellar team. So we work therefore also we check very carefully which team we can onboard for fundraising purposes, because at the end we want to work with champions. The market became very critical, and we need the champion, the top 5%, and these people are GPs that managed already very complex portfolio. They know how to litigate about performing per investment. They don't quarrel in a pitch when you have to talk with a new LP. So there are some protocols we check. And ESG is good, but also the matrices are very complex, how to report. So I think it's more about portfolio performance. Where I believe in is diversification is very important, and we like also smaller funds, emerging funds, because the chemistry is there, the pivotal spirit, hungriness, and it's very healthy. But I think it's the best is if you have a funds of funds and you aggregate the smaller players, 100 million fund, and you have smaller VCs that can start off. I think that's a very healthy development. And in Europe, there is a very monopolistic situation with big governmental funds of funds, and we need more corporate funds of funds that can support entrepreneurship.
Well said. Well, and Carl, you were mentioning research across different markets, different asset classes. You're also we've so far been talking about debt as well, right? So there is though a bit of, I think, of a spectrum on the debt side. That yes, there's more of a trend towards debt, but this comes with risks as well as with opportunities. So, for example, we did see when debt was very cheap that a lot of funds actually way over leveraged. We also saw banks and funds commit capital into long-term treasury bills that ended up really backfiring on them. So I know, Carl, that you have within ChainDLX protocols around, for your fund managers that you work with, protocols around what can and cannot be done with cash management, with treasury bill management, and then also that you have been working on internal leverage systems that can provide that debt upside without overexposing investors to risk. So curious
Yeah.
to hear your thoughts on that.
And I mean, David, you're well aware of this because you were going with your fund bears through this. So, for the audience, what David refers to is our protocols were years ago foreseeing disasters like FTX or like the banks going bankrupt, and it was not just that we were everyone. It's just like following normal secure protocols. You don't put billion of dollars in one bank account, 800 million, 700 million dollars. You have to have government bonds, short-time bonds, because when the bank would go bankrupt, the short-term bonds would be still yours. You're not allowed to invest when the interest rate is low, or also when it's high. You don't know how high it goes in a long-time bond when you need the cash for a cash position. This is the whole failure which we have from the banks. They bought 2% interest rate and they bought a 30-year bond just to get 1% more on the interest rate, and the interest rate goes up to like 5%, and suddenly they lose half of their cash position in the bonds and cannot get and go belly up, and the bailouts have to happen. This is the same thing for each fund. The money has to be carefully managed when it's lying in cash there. This is one thing which we require from our funds. It's all for protecting the investors when you invest in one of our funds. The next thing, regulations is, when it's internal security protocols. Theft always occurs and mostly occurs internally in companies. When we look at FTX, the theft was internally. So we have to look that we are shouldering the temptation that somebody could steal the money. So there is always multi-signatures, multi-leverage, so that nobody can really basically run away with crypto, especially in the crypto market, but also when it goes to bank accounts and so on. The last level of security is the leverage. You cannot go and leverage your fund at a certain level and risk to be wiped out. So how we provide the leverage is in a healthy ratio, calculated, and that basically the leverage comes internally by the funds from options when people buy convertible notes in our fund. So the convertible debt, they have then the decision to convert it later on in shares from the fund or borrow them fund money. And this is a leverage which we can control and which is internally controlled. So this is
one thing on that I would be curious to kind of get some perspectives on from everyone is that this internal leverage, Carl, that your team has set up systems and processes for ends up being in the roughly 20 to 30% leverage range, which I thought was actually very interesting in relation to a related topic being Sharia compliance in the investment management space. So a number of my friends and colleagues have mentioned, interestingly, as a kind of independent conclusion, that a lot of Sharia finance, or rather Sharia compliant investing, tends to restrict to make sure that the portfolio is roughly 70 to 80% compliant with Sharia, which, for example, if you use a system such as leverage, if it's 20 to 30% leverage, that would mean that 70 to 80% would not be leveraged. So thinking through this, I guess from a global perspective of emerging asset classes, emerging funds, and emerging trends in the space, Catalin, also curious if you have seen, given your involvement in the Middle East, in Southeast Asia, any trends in which there are differences between practices across countries?
Sorry,
as
I
well as
just want to say,
similarities?
our leverage, when you
Yeah.
say 30%, it was not, we did it not because of the Sharia law, it was basic math. It was
Right.
mass and security.
Right.
We are not like
Right.
like,
My point was what I found.
we are regulated by the Cayman Island Monetarization.
Right. What my point
Okay.
my point there
So-
was that what I thought was interesting there is that I see experts with different backgrounds, different regulators, different goals, different traditions arriving at the same conclusion from two different methods that we have. Carl and Chain VLX, Cayman based, thinking about this from Cayman regulation and from a mathematical analysis, and then other colleagues in the space arriving at very similar conclusions through a completely different path. And that to my point though signals a larger trend that if you have people in different countries, different backgrounds coming to the same conclusion in current markets, this must speak to broader trends. So to me, the question is more, what are some similarities and differences on a more local and regional level?
Oh, I'm happy to sum it up because we see the word.
You travel all over, yes.
I think Europe has become a little bit over-regulated and also a bit rigid and tough, whereas Middle East is more relational and okay, there is the regulation, but still everything can be done somehow, you know. Southeast Asia, very hungry, very big velocity, and anything is possible. And of course, we work in Singapore, we have there an office, so it's also quite regulated and hierarchic. But what I like is this spirit of thinking out of solutions. Europe is thinking for me, very often out of restrictions, like especially if you go to Germany, also, like what is not possible and why, and that's it, close line. Whereas you go to Southeast Asia, it's always a top up, always something possible. Middle East is the same, but you have to have people on the ground. I'm very excited about the markets because, of course, what I see in private markets, the beating heart is really Southeast Asia now, especially Hong Kong, very strong, Singapore, Australia with family offices. US and UK has two big problems, is the red tape. And of course with Brexit we saw also even more bureaucracy and very tough in deal making UK, so we also try to diversify, but for us in private markets currently the most promising is Southeast Asia. Why? Because you have of course Hong Kong, even if back to China, still they manage a lot of money from Japan, Korea, you know, developed countries, from private families, and that money is moving very fast, faster than in Europe from institutionals.
That makes sense.
Now I told the secrets behind the curtain.
Yeah, this is
Okay, shut off the cameras.
and this is exactly why when we work all on the same project, you need different people and different specialty in every project. You need the people which know which cryptocurrencies to buy, how to manage the investments. You need the regulation, compliance, the boring, and you need the people which see the potential in the different markets which change dramatically. When we see also right now, for example, Cayman Island was on the gray list till 3 months ago. Now Cayman Island is not anymore on the gray list, which makes investment over Cayman Island much easier.
Dramatically more streamlined.
Regulation, and when we see that tax withholding in America and Cayman Island, no tax withholding. So how to deal with an American investor in the Cayman Island fund, but also that understanding that probably an investor from Hong Kong doesn't want to invest directly in the US fund because he doesn't want to have 30% tax withholding when the fund invests in Switzerland. Why? Just because it's an American fund, there is 30% tax.
I suppose, and not tax advice, not legal advice, not financial advice.
Just common knowledge.
I suppose.
Hearsay.
I suppose that the worst nightmare, let's say, for an investor, for example, from Singapore or from Abu Dhabi, could be that let's say depositing investment funds into a U.S. bank account to then invest into a Swiss vehicle. could mean potentially
No, the worst
yeah.
nightmare is
Feed
that
your
it's a
funds,
bank
yeah.
which goes
Yeah.
belly up.
Well, yes. No, that's fair. So, but I think both of you raised an interesting point that yes, there needs to be the right vehicles in place for the right jurisdictions and for the right goals and priorities of each investor. So that is important. But also, you're both mentioning this diversity of opinion. So on that point, in terms of management teams, for example, and operations, I think this brings up an important point. So, Katalin, I know that a topic that you are passionate about is women-led investment initiatives. Carl, given your involvement with organizing a variety of, from a diversity of cultures and languages and business perspectives, you have been very involved with think tanks and roundtables with fund managers from a variety of national and ethnic backgrounds. Curious what your perspectives are in terms of diversity of opinions within management and partnerships, as related to, for example, gender diversity or linguistic and cultural diversity as well.
Sure. So there are two things in my business leading. I always embrace the diversity, but also with the age diversity. If you see my team, they are very young but very capable. I was very intrigued by recruiting people who are not there yet, but I see the trainability and the hungriness, and still it's very important for me to have not maybe I don't want perfect people. I want really people where you see there is a very big learning curve and appreciation for the circumstances. And of course, we work a lot with female-led venture capitalists. These are great ladies and great teams, and because it's kind of unexpected that they're there, I feel a lot of sensitivity in business making, also good budget management skills, and good portfolio returns. But again, I wouldn't position myself as a wild feminist. I like to work with GPs based on merit. However, I see when I entered private equity also 7 years ago, it was very underrepresented layer. So I actually only see the benefits because I really thoroughly enjoy working with men and making this kind of matching points. And but yeah, I've seen amazing businesses. We also have a fund, a film production fund in our portfolio, Mama Lion, and that is actually about female-led producers. And it's being experienced very successful, and lots of media attention. And just because these are very high-performing ladies, yeah.
Wonderful. Well, I like what you're saying about the balance of the perspectives. This is something that, as a CEO, as a head of a team, that I'm constantly trying to optimize for. That if we have, especially when we're talking about, for example, investment decisions, that if we were to have a team of people who were all only looking at digital assets from a traditional finance perspective, or who are all only looking at it from a crypto native perspective, then we would have issues. So we need the balance of the old ways of thinking and the new ways of thinking. We need a balance of mentalities based on different ethnic and gender backgrounds. And so this is also something I think that there can be a danger of, for example, on an investment committee, of having people of all the same background simply agreeing with each other, for example, and this leading to issues with investments.
To be honest, like what we are here addressing was addressed also in 1995, where diversity was not even, I mean, you were too young to remember, David. This was like business school 1995. Diversity was not addressed at all, but what was addressed was a psychological thing, group thinking.
Yes.
This is basically when you don't have a diverse team, and a team is like only like excluded from each other, from all the other inputs from the world, then the group thinking starts in, and everyone in the team suddenly feels like they are the geniuses and can manage everything. And then we have the disasters that the investments go wrong.
So how have you seen this in relation to your many years organizing Davos think tanks and roundtable discussions?
I see that there is now more diversity in Davos, but it's important diversity. But at the end, when something is done right, it's not done because there should be diversity. Diversity is automatically present if you set something up right. It is that you don't have to think about it. You don't think about preasing, how you to prease right. You prease right. So diversity is like preasing. It's automatically there. If it's not there, it's like you have asthma or something. It's strange. And basically, when the CEOs do their job right, when you set a group up right, and you look to get to a goal the quickest way and the best way, you finish up as a diverse team. You don't, this is right, and this should be done. And of course, sometimes you need that people are pressured to include diversity when they're too in a group thinking mentality already in, then you have to break it up with diversity. But then it's too late, and this is exactly what I think why you like to hire the people young, because you don't want them to learn the wrong thing. As soon as you hire them older, but now it's diversity already.
Exactly.
Discrimination against olders. Like you have to have also the old people in, you know.
Well, this is definitely something we're trying to balance.
Exactly. Age diversification is also important, but actually I also advised GPs 5 years ago. I saw the organizational chart and I see only white men and only men, and sometimes some analysts are women, and of course I like to see women in the board, you know, decision making role, make a women partner, but not because she's woman, just because it's also there are some good female leaders. So I always try to balance this discussion that it should be really based on talent as well. Like we need talented people, and at least in private equity you have to have the returns and
absolutely.
I mean,
pay back the investors. And
in today's world, we cannot afford to not take advantage of 50% of talent. And I mean, there is no difference in talent in any ethnicity, gender, and so on. Just by not be diversified and you just discriminate against 50% of the talent, you're out of business. Sorry.
Well, with that thought, any last thoughts or suggestions, advice for anyone who might be listening, Kathleen?
Yeah, maybe everybody's asking me, so what is so secretive about private equity, how you close deals? And I think my last thought that I would like to share is, private equity has always been known, okay, figures, returns, net IRS, but at the end, it's quite simple. It's a people business, and we sell teams, we sell good chemistry, and once you know it, then you know that you really have to invest in team bonding, have millennials, but also, of course, all the advisors. But I think human powder beyond dry powder. So that's my last message here.
Living powder.
Living powder, exactly.
I like it.
Face-to-face meetings, good events, like Davos,
Beautiful. Yeah. Carl, how about you? Any last thoughts?
No, I totally agree with her.
Well, wonderful. Well, thank you, Carl, and thank you, Kathleen, for joining us in particular. Already. Well, so thank you to our audience. Again, this has been a Digital Davos 2024 panel. This was a discussion brought from Digital Davos, sponsored by Chain DLX, and we are glad to have with us Kathleen Gaddis. Thank you again to everyone who is listening.